If you are in a deal and it says it's a 8% preferred return, that doesn't mean you get paid 8% a year. That means you get the first 8% of return per year. But if the deal, let's say the cash flow or cash distributed is only 3%, the other 5% that wasn't paid out, that's going to accrue.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Breneman, and this is the Breneman Blueprint.
All right, welcome everybody. Thanks for joining me on the podcast. Back with another episode here today. And going to talk about something that's really been sort of on my mind recently, and just really about fees. You know, this is for let's say, the passive investor to learn about fees that sponsors, people that are doing these real estate deals that you can invest in, what they charge, what's normal, what the fees even are for, or what they mean. If you say like, what's the acquisition fee? What does that even mean? I mean, so this episode's best for, let's say you're a passive investor who's in these deals, wants to learn more about really how things work and what's normal, what's not. And then, it's also should be for sponsors too. I mean, let's figure out what's sort of normal and best in class and do that. So really without any further ado, fees, those are important, where it's not really possible to charge no fees, where really any investment manager, in order for them to hire or retain the best talent or just afford even the technology that's needed, they're going to need to charge fees. So it's important for LPs to understand that. And LPs there's a term for limited partner, which is essentially like slang for the people who invest in these deals passively. I think back in the olden days, they used the GP-LP legal entity, or use a limited partnership legal entity where there's a GP and an LP, but sort of the LLCs, limited liability companies, those replaced that, essentially, where everybody's in LLCs now as members, but the term GP and LP still stuck around. So for LPs, it's important for them to understand there need to be some fees, but also important to get a gauge on what's appropriate when it comes to fees. So, really a lot of investment firms, they employ similar strategies. So the quality of the team and the technology really matters. And that's paid for with fees. So it's important to find a balance, let's say, between having fees that are normal in market, that are being used to build and support the company, and then fees that are just egregious. And they're just enriching, essentially, the sponsor, whether the deal goes well or not. So first fee to talk about is most common, let's say, thing you hear about, and it's the acquisition fee. And actually, kind of back up, I'll say, there's a kind of a couple categories of fees. I'll say, there's transaction fees. Those are charged when there's a transaction, so a buy or a sell of a property. Then there's ongoing management fees. So those are charged year to year as the property's running and being asset managed or property managed. And then there's the incentive fee, which is also referred to as a performance fee or a promote, depending on just who's using, what terms here. But so acquisition fees, ongoing management fees, and then the incentive fee. So those are really like the buckets. And I think I said acquisition fee. I meant to say transaction or transactional fees, ongoing management fees, and then your incentive fee or your promote are the real main buckets. So acquisition fee, that's definitely a normal fee you're going to see on really every deal. And, usually that's between 1% and 2% of the purchase price. And most often the percentage amount decreases as the purchase price increases. It's also dependent on how many other parties are involved in the transaction or getting paid. So let's say typically, like if it's a big deal, let's say you're buying a $40 million property. I mean, a 1% fee is 400 grand. So that's a lot of money. So then on, that's, you wouldn't expect it to be more than that on a property that size. But if the property is only $1 million, charging 10,000 for the deal, it might not be enough. And then really more charging 2%, on a deal that's, a few million or $5 million or something makes sense. So, and two, like I think another way to think about it is how many parties are involved is if the GP, the sponsor, if they found the deal directly, potentially, so they're doing, let's say, like the broker's job as well, they should be paid a higher fee too. So then if they're doing, broker, often they're getting paid 2-3% on a deal. So then if a sponsor, normally a broker gets paid 3% and the sponsor takes a 1% acquisition fee, I mean, there's 4% of fees getting paid out. So if they found the deal on their own and they wanted to charge a 2% acquisition fee, that would be, normal in my opinion as well. So, and then that fee that's paid at the time the property is acquired, usually it's right on the settlement statement. So, if you wanted to ever verify in a deal that you're in, like how much was the acquisition fee, just ask for the settlement statement. It should be right on there, or for sure in the accounting for the partnership. So, some other fees you'll hear about, but they're less common. So it's okay if there's, a couple of, one of these fees maybe on a deal, but definitely not all of them, what I'm about to start listing. But I think it's important to just kind of explain them. Then at least if you see it, you know what it's for. So I guess the first fee that you might see, but is not super common to get paid to the sponsor, is a debt placement fee. This is a fee paid for sourcing the debt and is typically between 0.5% and 1% of the total loan amount. So sometimes sponsors will have in-house capital markets teams responsible for sourcing the debt. And then that's where they might make the argument like this: I'm doing the debt broker's job, and I should get this fee. But really, most often, this kind of fee, you're going to see it getting paid to a third-party mortgage broker. And those mortgage brokers, they do add a lot of value. They understand the capital markets. They have relationships with different lenders, and they can source the most favorable terms. So, and that's typically in that range, where 1% or less is what I think is most common for those third party, equity and debt brokers to get paid. So, or I should say, for the debt piece, equity is usually a little different. And so, another fee you might see is an equity placement fee. So, that's usually paid to an internal or external person or team who raises equity for the deal. So that's the down payment money, like a fee for finding the investors. And, if you see that, usually, let's say market would be, 2 or 3% of the equity raised. So, but this fee is going to be uncommon in syndications. So if you're an individual listening to this is not a fee you should expect to see in your deal. Really, where you'll see it is if you're finding, let's say, one check investors, I call them, where if they like your deal, they'll invest all the equity in it. And so you might use an equity broker for that. And a lot of these bigger brokerage shops like CBRE or Northmark or Jones Lang LaSalle, like they have folks that work there and they raise debt and equity. But the equity they raise, they don't go to like individuals for $50,000 or $100,000 per person. They're going to family offices and big groups that can put in like 5 or 10 or 20 million in a deal. And for those, like the fee that would be normal would be in that 2 or 3% range. So if you find yourself somehow in a deal like that, that's what would be market for a fee. Loan guarantee fee would be the next fee you might see. I would say this fee is uncommon, like all the others I'm listing off now. Usually that's paid to the guarantor of a loan. And, I've seen a wide range of these, typically 1 to 3%, I'd say, is market, 1 to 3% of the total loan amount. And then I guess kind of how they decide within that percentage is how risky is it? If you're buying a full apartment building and you see this fee, I mean, 1% would even be really high on that. That's a safe deal, a safe loan. Whereas if it's a new development construction deal, that's the riskiest type of loan you could make. The building's not even built yet. There's a lot of moving pieces, that's going to be a higher fee. So I think, typically though, sponsors or GPs, whatever you want to call them, they're providing loan guarantees as part of why they're getting their promote or their incentive fee. That's essentially a service that they're providing to the partnership that's buying the property. And that's why they're getting this additional profit share, is for doing the work and taking on more risk than the other investors.
This episode is brought to you by Breneman Capital, the firm I started to help others invest in real estate. We invest in multifamily assets that meet our very strict criteria in locations positioned for the most growth. We use institutional quality investment models and processes and combine that with old school hustle to generate superior risk-adjusted returns for our investors. Invest now or learn more at Breneman.com.
There are companies that provide loan guarantees. So, I mean, if you see someone in a deal using a third-party company that provides loan guarantees, I think their fees are still in line with that sort of 3%-ish, for that service, if you will. I guess if you do see that, though, I'd be a little worried about how good the sponsor is on that deal, where if they need a company to guarantee their loans, and they don't have any investors that would be willing to help them with that, and really they're turning to a company, I'd definitely ask about that. Like, what's the deal? Not the end of the world, worst red flag, but just something to think about. You're definitely dealing with a sponsor that doesn't have a lot of financial wherewithal at that point, or they're doing a deal that's just, I guess if they do have a lot of financial wherewithal, they're doing a deal still that's very large for them. So another transactional fee this is probably, I'd say, the second most common fee, but I think you should still not be paying it or seeing it. And that's a disposition fee. So some sponsors, they charge a fee for being part of the sale of the building. Now, they're not the broker selling it. They're just charging a fee similar to like with the acquisition, where there's a lot of front end work, buying the property, getting things set up, and selling's a lot of work as well. And this is where they justify this fee. At the same time, when a building sells, if the deal was successful, they're getting their incentive fee. So it's just kind of, to me, like a double dipping, on the way out, if you will. So I would not say this is a common fee, but if you do see it, I think what I've seen is as a market fee is 0.5% to 1% of the sales price. So at least if you see it, you have a gauge on like what market is for that. And then another fee you might see at the time of a transaction would be when you see a refinance happen. So similar to the debt placement fee, sponsors might try to charge a fee when the property refinances, or when they refinance the loan on the property, I should say. Again, not a super common fee, but if you do see it, I think 0.25% to 1% of the total loan amount for helping arranging that refinances market. But you would never see a deal with all these fees for the transactions. I mean, I'm just trying to give you basically every fee you could ever see and what's like a normal range for them. But if you see, an acquisition fee, a debt placement fee, a disposition fee, a refinance fee, there's too many fees. Like the person running the deal is going to make a lot of money even if the deal goes poorly. So I'd avoid anything with that many fees. But I just to explain what they all could be, for example, like on our deals, out of all those fees I just mentioned, we only charge a acquisition fee. All these less common fees we're talking about, we don't charge. So ongoing management fees, like what you're going to most commonly see there, are really just like 3 types of fees year to year are going to be the most common. And sometimes these are paid to the sponsor. Sometimes they're paid to another company like the property management company. So first most common fee you're going to see is an asset management fee. Next would be organizational costs. Admin costs is what sometimes people refer to this fee as. And then the third one would be a property management fee. So what are these? So asset management fees, what those are fees that pay for the investment management services. So typically those are charged as a percentage of the total equity that's invested, and that's an annual fee. Sometimes they're charged as a percentage of the effective gross income, but typically what I've saw is a 0.5% to 1% of total equity invested in a deal is a market for an asset management fee. If it's charged on the revenue, the effective gross, let's say, I mean, typically, what have I seen for that? I'd say 1 or 2% would be market. And then on deals that are smaller too, you might see a higher fee. Like if it's only a few $1 million property or something, a 2% asset management fee wouldn't be crazy to see, because that might be, $10,000 a year or something, when that gets eaten up pretty quick with some of the work on having someone help run the deal. So, because there's a lot of work on actually driving the business plan year to year, and you're talking to the property manager weekly if you're doing or the property management company, if you're doing a good job with the asset management, you're pushing the project along, you're setting the rents, you're really like setting the vision and executing it through the management company. So asset management is really a huge piece of success in one of these deals. And then for, let's say, the admin or organizational fees you might see, this is usually not a lot of money, and it's not a percentage like all these other ones so far. This is just going to be, there's going to be costs throughout the year for legal, marketing, technology, investor relations, renewing the LLC, those types of things. Fees really vary here, but so I would just kind of use sort of your judgment on what would be normal. If like a sponsor is trying to pass through like their entire cost of having an investor relations team or software on a single deal, that doesn't make sense. A lot of like the only costs we charge that are on this section would be if there's an actual legal bill for the property, we charge that. And then two, we have you got to renew your LLC or LLCs every year, so there's a cost for that, but we just do that, so we don't use an attorney for that. And then so there'd just be like a annual renewal fee on that. So and then kind of most common fees from here, are the ones that would be paid typically to a property manager. So property management fee, those are for the day-to-day property management and operations of the property. That ranges from 2 to 5 or even 6% of the collected gross income. So the effective gross income, it could go to the sponsor if they have an in-house property management team, or it's paid to a third-party company like I'm talking about. Really every deal is going to have those, and really just a percentage of what is this property management fee, what's that going to be, the actual cost. Just depends on how hard the deal is to run and then how large it is. Just the easier the property is to operate and the larger, the lower the percentage. So if you have a tough, older, smaller property, expect to see 5-6%. If you've got a nice, new, big Class A deal, then expect like 2% a year. So leasing fees or leasing commission, I mean, this is really common on the commercial side and in some markets for residential, where you need to hire somebody to lease your vacancies. There's going to be a cost for that. Typically, this is outsourced to third parties, but if you ever see a leasing fee or commission, let's say you're in an industrial deal and there's a fee paid, I mean, it's just like when you sell a house or anything, like you pay a commission to your realtor. This is similar, where in these commercial properties, they hire brokers to lease their space, where the brokers are well networked and know what tenants are looking and what market rates are for everything. And so then they can help you get the best deal for your space and get it rented quicker than just the average person could. So they definitely earn their fees. Then sort of lastly, on another fee you might see year to year is on a redevelopment deal or renovation deal or development deal. You could see a construction management fee. So these are going to be, usually the fee is based on the total costs. So let's say you're buying a deal, you're a part of a deal where they're buying a property and they're going to do a renovation. They're charging the fee just on the renovation hard costs. And I'd say market for that is 3 to 10% of the total construction costs. So that's going to be, when would it be 3%? When it would be on the lower end? That would be if, let's say, it's a development deal and an entire building is getting built. So then that's the fees being charged in a much larger total hard cost number. Whereas if you're just doing an apartment renovation on a deal that they acquire it and they're going to renovate, a handful of units. I mean, 5 to 10% is definitely normal for that, because it's a lot of work to coordinate all that. And the actual construction dollars is as a percentage of the whole deal isn't really even that much. So, and now, really, so then the last sort of fee to think about or know about is the incentive fee. I mean, most commonly people call this a promote. So I think that's, I'll call that this the promote the rest of the way, hopefully here. So, a promote, is really, it's where the manager, the investment manager, the person running the deal, the GP, they receive a disproportionate share of the total profit relative to their initial investment if the deal outperforms certain return hurdles. So usually these return hurdles are defined with an IRR or equity multiple after a preferred return that the limited partners must receive before this profit split starts. So usually things are best explained with like an example, but I think kind of the most common like incentive fee structure that we see like day to day, let's say if it's on like the institutional one check value add space, what's most common right now is a 8% preferred return. So, and that doesn't need to be paid each year. That's something else worth knowing. Like if you are in a deal and it says it's a 8% preferred return, that doesn't mean you get paid 8% a year. That means you get the first 8% of return per year. But if the deal, let's say the cash flow or cash distributed is only 3%, the other 5% that wasn't paid out, that's going to accrue. So then next year, they need to pay the 8% for that year, as well as pay off the balance that's accrued at some point. So then that's, I think, a key thing to know, where if one deal has a higher preferred return or not, doesn't necessarily mean that one's better than the other. So it's just where a lot of it's going to come down to what's the actual return of the deal at the end versus more what's the preferred return getting paid out. Because most typically in today's times, like a lot of that's accruing anyways. But in the institutional one check LP space, 8% preferred return, then a return of capital, and then just the split 80-20 thereafter. So the LP would get 80% of the profits after that, and then the GP gets 20%. And then we have sort of the syndication value add space. So really there, this is now we're talking more individual investors. It's more work for the sponsor. Deals are typically smaller. And what's most common there is still a 8% preferred return. I've seen some sponsors that do 6, some that do as high as 10, but still I think 8% is most common. Again, but not many deals pay 8% out per year on a current basis, so a lot of that's accruing. But 8% preferred return, then a return of capital, and then the incentive fee starts getting paid. And usually that's done in where there's different tiers. So the first split is 80% to the limited partner, 20% to the general partner, until the deal's made a 12% IRR. And then the split changes to 70% to the LP and 30% to the GP until it hits a 15 IRR. And then the splitting 50-50 is most common from there. So again, there's a lot of nuance there, where if you're buying a really safe core type deal where they're not as risky, I would expect to see a lower preferred return, maybe 6%. And then similar splits after the 6% to what I just said. But then if you're in a development deal, maybe the preferred return, it should be 10%. It's all going to be accrued anyways. There's no cash flow. And it's a lot more risky. So I think then maybe the investor's making 10% before the sponsor gets anything makes sense on those. So two, I think a couple other things too, where to know about with the preferred returns and just kind of those incentive fees. I think one, you're going to want to ask or look, does this, the preferred return, does it compound if it's not paid? So you want it to accrue, but you also, ideally, it would be cumulative and compounding. So where, if it's non-cumulative, I guess to start with one thing at a time, then it's not, if it doesn't get paid, you lose it. So you want to make sure it's a cumulative payout where if it wasn't paid in year one, it's going to pay in that's just going to accrue and be paid in year two. Then ideally you'd also like it to compound. So if let's say you're not, you're paid 3% year one when you have an 8% preferred return, if it's non-compounding, then that 5% you weren't paid, it's just going to stay 5%. And until just whenever it's paid, it could be paid 5 years from now. It's still going to be that same dollar amount. If it's compounding, that 5% not paid yet is going to keep growing at whatever that preferred return is. So then it would grow at 8% a year as well, or whatever is determined in the documents. So then the money you weren't paid yet is still making money. So that's something to look out for. And then I think the last thing to touch on with incentive fees or waterfalls or whatever you want to call them is the term catch-up. So what that is, and I'm not talking about the ketchup you eat. This would be the term. It's CATCHUP. So catch up. And what that is let's say the goal, and these are not that common, but actually could work really great for like a long-term hold. And I'm surprised more people don't use them, to be honest. I think it sounds complicated when you explain it, but it's really not. So let's say the goal was between the GP and LP that they wanted to split 80-20 at the end of the day. This is just, we want to split 80-20. So you get 20% for doing the work, and the investors, they get 80% of the profits, let's say. A way you would typically see that structured, if they weren't just going to split 80-20 straight up from day one, would be where there's going to still be a preferred return, then a return of capital. And then the catch-up is there's going to be a disproportionate share of the money, usually 50% or even 100% for a period of time is going to get paid to the sponsor until they meet that agreed upon split. So let's say in this example, 80-20 on the whole deal. So what that might sound like if you're talking about it would be this deal has a 9% preferred return. Then there's a return of capital to the investors. And then from there, there's 100% catch up until we've split 80-20 on the whole deal. So 9% preferred return, capital's return to the people who put in the initial capital contributions. And then from there, 100% is going to go to the sponsor until we've split 80-20 on this whole deal. And then it stops being 100% to the sponsor and would go back to what that split is, 80-20. Then from there, they're going to split 80% to the LP, 20% to the GP. So really great structure long-term for a long-term hold. Because one thing you really want to think about with any of these fees is what are the incentives of everybody? And a deal where there's a ton of fees, but maybe it has a really high preferred return or something, that might, the high preferred return might sound great, but that sponsor is making so much in fees. Maybe, they might, who knows how much they care about how well that deal goes. So, whereas if something, if the deal was just split 80-20 with a catch up in there or even not, and there were no fees, now you're entirely, the alignment of interest is great where you're both getting paid only at the exact same times. When the building makes money, at the same time, there's no fees. The investor put in a bunch of money, but then the sponsor's getting a fee right away. So one thing to think about is what incentives are created with this, because the most common structure, for the incentive fee is, and let's say also there's just to make the example more extreme here, and there's also a disposition fee. So you don't get your incentive fee until you've paid the preferred return, returned all the capital, and then you start getting a split. So in today's market, really the only way to do that is to sell the property. And so if you're in a deal where there's a disposition fee and the sponsor doesn't get paid till there's a full return of capital and the pref's paid, well, all of the incentives are telling that sponsor, sell if you want to get paid. So they're going to hold the deal, as long as they can. But if the sponsor needs money, maybe they'll be pushing to sell a deal that would have been better off holding and riding the wave or whatever thesis you had to buy it. Maybe it's still valid and this is still a great asset to own, but you might be selling it early because of the incentives you've created for that sponsor. So something to definitely think about with all fees, whether they're the transactional ones, the ongoing ones, or the incentive fee. Think about what kind of incentives those fees create, and maybe adjust your deal accordingly if you can. So appreciate you joining today. So happy to run through this with everybody. Something that's been, especially if you're a passive investor or something where it's hard to get this information. People, it's, you have to look at a lot of deals to understand it, or really be sort of on the sponsor side to know what's normal, what's needed. So hopefully that was helpful. Again, there's going to be fees on every deal, because there's no way you're going to have a good company, good investment team if you're not charging any fees. That's as much of a recipe for disaster, having not enough of an incentive fee or transactional fee. That company is not going to be able to be around to support the deal you invested in. There's going to be no money coming in, or they're not going to have the team needed or the resources to run that deal well. So there needs to be a balance for sure on what fees can be charged, where there need to be a reasonable amount of fees so the sponsor can have a good team to run the deal, but also it can't be egregious. So hopefully this was all helpful. I'm sure it was. So appreciate you joining it. And don't forget, check out our website, breneman.com. Tons of stuff on there. I think I also covered that in the outro, so I'll just let that speak for itself. So appreciate it. We'll see you.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Breneman Capital's website, breneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording, and do not purport to reflect the views or opinions of Breneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.